All right, so let's talk money. Monetary policy is one of the tools that the government has at its disposal to help stabilize the economy. And basically, it just involves using the money supply to smooth out some of those problems that we face, such as inflation or recession. So, I'm just going to give you a quick overview of the system itself, um, main ideas with policies, and what the difference is between expansionary and contractionary policy. So, first of all of this is conducted by the Federal Reserve Bank. This is essentially the central bank of the United States. It oversees our banking system. It's called a quasi government agency. It's basically politically neutral. However, it is funded and run by the federal government. The main goal of the Federal Reserve is price stability. So when we experience things like inflation, where prices are rising rapidly, that is firmly on the shoulders of the Federal Reserve and their policy. So there are lots of things it can do to help tamp down those inflationary pressures, as you will see. There are 12 district banks. So the country is split up into 12 districts, and each district bank enacts monetary policy at the behest of the Federal Open Market Operations Committee, the FOMC, um, which is located in New York. They also meet in Washington, D.C. All of the presidents of the district banks will meet in Washington, D.C. So those districts do things like put new currency into circulation, remove old currency from circulation. They will provide banking services for the government. They're the bank of last resort to lend money to other banks to keep them from failing. Those are the types of functions that they serve. So again, definition of monetary policy is just the use of the money supply to stabilize the economy. There are a number of different ways that the Fed can enact monetary policy. So the first one would be with interest rates. Interest rates are simply the price that's paid for the use of money. So it's the price of borrowing money, essentially. And interest rates are determined by the supply of money and the demand for money. So when we learned about demand and supply and equilibrium price, the interest rate is simply the equilibrium between the supply of money and the demand for money. So if you see an increase in the supply of money, that's going to be a rightward shift of the supply of money curve. That's going to cause the interest rate to change based on the fact that when supply shifts right, equilibrium goes down. That means interest rate goes down. So in general, as the government offers or puts more and more money into the money supply, not only does it increase inflationary pressures, it also lowers interest rates, which make it cheaper to borrow money, which encourages people to spend and borrow more money as well, which further increases inflationary pressures. So the tools of monetary policy themselves, first of all, are open market operations. So this involves the buying and selling of government securities, things like treasury bills, treasury notes, treasury bonds. The Fed will buy securities from banks and the public in order to increase the money supply. So those securities are sold to the federal government. The government responds with cash to individual investors and banks. That puts more money into the money supply, which then can do things like increase the supply of money, shift the supply curve right, lower interest rates, encourage more spending. So that would generally be used in cases of recession to encourage people to spend money to get out of that recessionary gap. If the Fed sells securities to the public, they're doing that to decrease the money supply. So money from the public comes to the federal government. The government gives them the securities in exchange. Now there's less money in circulation, more in the hands of the Federal Reserve, and then they pay that back, in theory, with interest at the end of a date of maturity. A second tool of monetary policy is the reserve ratio. So banks are required to keep a certain amount of money on hand in reserve, and they're allowed to loan the rest of those deposits out. So most recently, the reserve ratio has been 10%. So for every $100 that's deposited in someone's account, savings account, the bank can loan $90 of that out, but they need to keep the other $10 on hand. So that allows banks to increase the money supply through a series of loans. Um, if the Fed wants to discourage people from borrowing money, discourage people from spending money, one of the things they can do is raise the reserve ratio. They haven't done that in many years, however, because it would change the balance sheets of banks and could potentially cause banks to go bankrupt. But it is a tool that is at their disposal. The discount rate is the rate at which the Fed loans money out to other banks. So this is the base interest rate that all other interest rates are based upon. And the Fed most recently, so it's currently, as I make this video, 2023, our economy has been experiencing high rates of inflation. So the Fed has been increasing the discount rate, which then causes all other interest rates to increase as well. And that discourages borrowing, that discourages spending, that lowers inflationary pressures. All right, so we've got three main tools. They all involve the interest rate. So it's open market operations to influence the size of the money supply. It's reserve ratio to changing the reserve ratio to influence the size of the money supply. And then it's adjusting the discount rate to encourage or discourage spending. So there are two main types of policies when it comes to monetary policy. The first is called expansionary. It's generally used when the economy faces a recession. There's a GDP gap, a negative gap. That is the difference between what the GDP actually is and what it could be if all resources were fully employed. So when the economy faces a recession, the Fed can buy securities, they can lower the discount rate, they can lower the reserve ratio, they can do all three, and what will happen as a result is an expanded money supply. So in the years prior to 2020, from our last recession, the Great Recession in 2008 to 2009, we had a long period of lowering or a low discount rate. Interest rates were very low, and really for 15 years, the government just kept the discount rate very low, and that encouraged people to spend money. When they increased the money supply by giving out stimulus checks during COVID, that started up the inflation machine, where the expanded money supply led to declining values of currency and increasing prices. But in general, you would see expansionary policy when you're facing a recession. Contractionary monetary policy is used to contract the size of the economy, contract the size of GDP, cool down an overheated spending situation. So it's used in periods of rising inflation, and it's the opposite policy action. So the Fed will sell securities to the public, they'll raise the discount rate, excuse me, they will increase the reserve ratio, and all of these things serve to decrease the money supply, causing increases in interest rates. That encourages people to save money rather than spend it. There's less competition for goods and services, so we see price levels stabilize, and it helps remove some of that inflationary pressure.